Okay, so you've been working for 40, maybe 50 years. You've paid into Social Security your whole life. You get that benefit statement in the mail, or you log online, and you see a number. Let's say it says you're going to get $2,800 a month when you turn 67. That's your number. That's what you've earned. That's what you're expecting. Here's the problem. That number is a lie, not because the government's trying to trick you, but because you're looking at the one number that doesn't actually represent what hits your bank account. The Social Security Administration just showed you a piece of the picture, and there's a whole other piece they're not highlighting. Let me be clear about something first. Social Security isn't broken. The system works exactly the way it's designed to work. The problem is that most people don't understand what it's actually designed to do. They think Social Security is a simple formula. You work, you pay in, you get paid back. 40 years in, 40 years of checks out. That's the plan in your head. And it's not a bad plan. It just doesn't match reality. Here's the thing. Social Security isn't just one benefit. It's a collection of different payments, deductions, and adjustments that stack on top of each other. And most people don't see them coming until they're already happening. The number on your benefit statement? That's your primary insurance amount. Your PIA, it's the base benefit before anything else. But the actual check you receive every month is your PIA minus a bunch of other stuff. Let's start with the basics of how your benefit actually gets calculated, because this is where the first surprise hits most people. The Social Security Administration looks at your top 35 years of earnings. Not all of your earnings, your top 35. If you worked 40 years, they throw out your 5 lowest earning years. If you only worked 30 years, they count 5 years at $0. That zero gets averaged in. That matters more than you think. A person who took 5 years off to raise kids, or was laid off and underemployed for a stretch, that person's benefit is permanently lower because of those missing years. The math doesn't care why the years were empty. It just counts them as zero. Then your 35 years of earnings get adjusted for wage growth. A dollar you earned in 1985 wasn't the same as a dollar in 2005. So the Social Security Administration adjusts everything to current wage levels, runs it through a formula, and arrives at your primary insurance amount. That formula is progressive, which means it replaces a higher percentage of lower earners' income than it does for higher earners. A person who made $30,000 a year replaces about 40% of their pre-retirement income. A person who made $120,000 replaces about 30%. The system is deliberately structured to help lower-income workers more than higher-income workers. Now, here's where most people get surprised. The moment you decide to claim your benefit, a whole different set of adjustments kicks in, and these adjustments can swing your monthly check by hundreds of dollars in either direction. Let's talk about age first, because this is the big one. You've probably heard that your full retirement age is 66 or 67 or 68, depending on when you were born. Full retirement age is the age where you get your full primary insurance amount, your PIA. But here's what that actually means. It doesn't mean that's the age you get to claim. It means that's the age where you get 100% of your calculated benefit. You can claim as early as 62. But if you do, your check gets reduced permanently. Permanently. We're not talking about a temporary cut. We're talking about a reduction that applies to every single check you receive for the rest of your life. Claim at 62 instead of 67, and you're looking at a reduction of about 30%. Your $2,800 check becomes $1,960 every month for 30 years. That's $100,000 less in lifetime benefits just because you claimed 5 years early. But here's the counterintuitive part that catches people off guard. Waiting longer than your full retirement age also changes your benefit. Claim at 70 instead of 67, and you get an 8% boost per year. That's a 24% bump on your entire check. Your $2,800 becomes $3,472 every month. For the rest of your life, this is the first trap nobody budgets for correctly. The age you claim isn't just about when you need the money. It's about how long you're likely to live, and most people underestimate their own lifespan. If you claim at 62 and you live to 90, you spent 28 years taking a 30% cut on every check. The person who waited until 70 and also lived to 90 took 8 years of $0, but then got a 24% boost for 20 years. The math flips. The person who waited ends up with more total money. But you don't feel that in month 1. You feel the person claiming early feels ahead for 5 years, then the math slowly catches up. Now let's talk about taxes. And this is where a lot of people get genuinely angry when they understand it. Social Security benefits are taxable income, not in the sense that you send money back to the Social Security Administration, but in the sense that they count toward your federal income tax calculation. If you have other income, your Social Security can push you into a tax bracket you weren't expecting. Here's how it works. The IRS has this thing called combined income. It's your adjusted gross income plus non-taxable interest plus half of your Social Security benefits. That combined income number determines how much of your Social Security is taxable. If you're single and your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefits can be taxable. If you're above $34,000, up to 85% can be taxable. That means if you're taking Social Security and you have a pension, or you're taking distributions from a 401k, or you have other retirement income, your Social Security benefit becomes partially taxable. For a married couple filing jointly, the thresholds are higher, $32,000 to $44,000 for the 50% bracket. But the principle is the same. A couple with a modest pension and Social Security can end up paying federal income tax on benefits they paid into for 40 years. And most people don't budget for this until they file their first tax return in retirement, and the number shocks them. There's a whole other layer to this, too. Your state might tax Social Security benefits. Most don't, but some do. If you live in Colorado or Connecticut or Kansas or Minnesota or Missouri or Montana or Nebraska or New Mexico or Rhode Island or Utah or Vermont, your state considers Social Security taxable income. That's another hit on your monthly check that the benefit statement never mentioned. Now let's talk about something that catches people completely off guard. The government pension offset and the windfall elimination provision. These two rules exist because Congress wanted to prevent double-dipping on government benefits. They sound technical. They're actually quite simple, and they can cut your benefit by up to 50%. Let's say you're a teacher. You worked for 30 years in the school system, and you got a pension. You also paid into Social Security during those 30 years. When you turn 62, you're entitled to both the teacher's pension and the Social Security you paid into, except you're not. The windfall elimination provision reduces your Social Security benefit because you have a pension from non-covered employment. The reduction can be substantial. For someone who earned a modest teacher's pension, the formula can reduce their Social Security by hundreds of dollars a month. It's not eliminating the whole thing, but it's not a small adjustment either. The government pension offset works the same way for spousal and survivor benefits. If you qualify for a spousal benefit based on your spouse's earnings, but you also have a government pension, the pension offset reduces your spousal benefit by 2/3 of your pension amount. This one catches spouses by surprise all the time. You thought you were going to get a spousal benefit. You get a pension from a government job. Suddenly your spousal benefit is gone, or nearly gone. These two rules affect millions of people, and most of them don't find out until they go to claim. They get to the Social Security office, apply for their benefit, and the caseworker says, "Oh, by the way, because of your pension, your benefit is actually 40% of what we calculated." Let's talk about the marriage and divorce piece, because this is where the psychology gets really interesting. If you were married for at least 10 years, you can claim a spousal or ex-spousal benefit even if your ex never paid into Social Security. If your ex's benefit was higher than yours, you can claim up to 50% of their benefit at your full retirement age. That's the rule, except it's not that simple anymore. If you were born after January 1st, 1954, you can't claim a spousal benefit unless you're also claiming your own benefit at the same time. The rules tightened in 2015, and most people who got divorced between 1985 and 2000 never updated their understanding of how their benefit works. There's also the government pension offset affecting spousal benefits, which we talked about. But then there's also the issue of what happens to spousal benefits if you die. Your surviving spouse can get a survivor benefit equal to up to 100% of what you were receiving or what you were entitled to receive. That's good. But if your surviving spouse is also eligible for their own Social Security benefit, they can't collect both. They get the higher of the two. That's the rule. So a surviving spouse who gave up work years to raise kids and has a lower benefit, they get to collect either their own lower benefit or 75% of their spouse's benefit, if it's higher. Not both. Not even close to what people assume when they think about what their spouse will receive when they're gone. Now, let's talk about the big one, the earnings test. If you claim Social Security before your full retirement age and you're still working, every $2 you earn above a certain threshold, you lose $1 of benefits. In 2025, that threshold is $23,240. Earn $1 more than that, and you lose 50 cents in benefits. Earn $50,000, you lose $13,000 in benefits. It's a dollar-for-dollar reduction, and most people who retire early and think they're going to claim Social Security early and supplement with some part-time work don't understand this rule until they see their benefits cut. There's one more wrinkle. The year you hit full retirement age, you can earn unlimited income with no penalty, but only for the months after you hit that age. So if you hit full retirement age in June, you can earn as much as you want from June forward with no penalty. But January through May, the earnings test still applies. It's one of the few rules in Social Security where the timing of your birthday actually matters for the math. Let's step back and look at what's actually happened here. You calculated your benefit. 40 years of work, maybe 45. You got a number, $2,800, but that number doesn't account for the age you claim, which can swing your check by 50% either direction. Taxes on your benefit, which can take another 5 to 15% depending on your other income. A pension from government work, which can cut your benefit by 50%. Marriage and divorce, which can change whether you get a spousal benefit. Continuing to work, which can suspend your benefits entirely until full retirement age. Your state taxes, if you live in one of the 13 states that taxes Social Security. By the time all of these actually stack up, that $2,800 number might be $1,900. It might be $2,200. It might be $3,500. The number on your benefit statement is the one variable that's almost never what actually shows up. Here's where the psychology gets important. Most people think of Social Security as a formula. Input your work history, output comes your benefit. It's mechanical. It's fair. It's straightforward. The truth is more complicated. Social Security is a collection of rules, many of them written in the 1980s when the world looked different. And the rules interact in ways that reward some strategies and punish others. A married couple who coordinates their claiming ages can get tens of thousands of dollars more in lifetime benefits than a couple who doesn't. Someone who understands the earnings test can structure their retirement work differently and lose $50,000 less in benefits. Someone who knows about the government pension offset can make different career choices 30 years earlier that protect their benefit. The system isn't rigged. It's just complicated. And the complication costs money if you don't understand it. Let me give you two real scenarios because this is where the actual impact shows up. Let's call them Sarah and Michael. Both are 58. Both are married. Both have worked for 40 years. Both have employer pensions. Both will have similar Social Security benefits. $2,800 a month at full retirement age. Sarah claims at 62. She gets $1,900 a month, 30% reduction for early claiming. She also has a teacher's pension of $2,000 a month. The government pension offset cuts her Social Security by 30% of her pension. Her actual benefit becomes $1,300 a month. She's 62, she's retired, she's getting $2,000 from her pension and $1,300 from Social Security. $3,100 a month total. She figures she did okay. Michael waits until 70. He delays his claiming by 8 years. He keeps working part-time, makes about $15,000 a year, which is under the earnings test threshold. No benefits are suspended. At 70, his benefit is now $3,472 a month, the 24% boost for waiting. He also has the same teacher's pension, $2,000 a month. The pension offset applies to his benefit too, but because his benefit is higher, the hit is bigger. His actual benefit is $2,400 a month. Together with his pension, he's getting $4,400 a month, $3,600 a year more than Sarah. Over 20 years, that's $72,000 more in benefits, all because he understood the math and made a different choice. That's the thing about Social Security that nobody tells you when you're working. The benefit statement they send you is true, but it's also incomplete. It's the benefit you'd get if you claimed at a certain age and had no other income and no pension and no complications. The real benefit, the one that shows up every month, the one that matters to your actual retirement, that's something else entirely. The people who actually come out ahead in Social Security aren't the ones who get lucky or who make random choices. They're the ones who understand what the statement actually means and what it doesn't mean. They're the ones who know that waiting costs money in the short term but builds money in the long term. They're the ones who understand how pensions and taxes and spousal benefits interact. They're the ones who have a strategy. Your benefit statement is real, but it's not your benefit. It's just one variable in an equation that has 8 or 9 other variables. And most of those other variables are working against that number, quietly reducing it, unless you understand how they work. That's the thing about Social Security that surprises people most when they actually retire. The system makes sense once you understand it, but nobody explains it beforehand. You find out when the checks start, and by then, the decisions you made 10 years earlier, 5 years earlier, sometimes just 5 weeks earlier, they're already locked in, and you're stuck with them.